What is a pip? A pip is a measurement of the price change in a currency pair trading on the Forex market. More precisely, a pip is in most cases equivalent to 1/100th of 1%. This is true in most cases because in general, currency pairs such as the US dollar-euro are quoted to the fourth decimal place. However, this is not true for the US dollar-Japanese yen currency pair, which only quotes to 2 decimal places. Let's look at an example. Nina, a seasoned Forex trader, is looking for a quote on the US dollar-Canadian dollar currency pair and sees that it's being quoted at 1.1005. And she wants to buy $10,000 worth of Canadian dollars, which at the quoted price would mean she has to pay $9,086.78 US dollars, as established by the equation 1/1.1005 times $10,000. As she's watching, the pair sees a 1 pip increase to 1.1006, meaning the US dollar appreciated relative to the Canadian dollar. She now only has to pay $9,085.95 for the CAD 10,000 determined by 1/1.1006 times $10,000. This is the difference of doesn't sound like a big difference, but when a position is leveraged 50 times, that single pip equals $41.50, and currency can easily move 70 pips a day. This means a $10,000 position at 50 times leverage could see gains or losses in excess of $3,000 throughout the trading day. Pips are the most basic unit of measure in Forex trading, so it is important to learn how a pip's value relates to currency positions in Forex trading.